In chapter 17, we continue to look at variance analysis, similar to chapter 16. So we look at profit variance analysis. So what do we do with those variances that occur between our actual results and our budgeted results? So we monitor those variances throughout the year. We can update our standard costs throughout the year. And then at the end of the year, we hope that those variances will have leveled out. So we might have months where we have higher costs and months where we have lower costs. And then by the end of the year, we're just going to have an amount in that variance account that we record our variances to. We treat this much like our overhead allocation and whether we have under or over applied overhead. So with our variances, if it's a small amount, we're just going to write it off to cost of goods sold. However, if it's a material amount, we need to prorate those variances between our work in process inventory, our finished goods inventory, and our cost of goods sold, just like we would with a material amount of under or over applied overhead. So we're looking at a profit variance analysis for 90,000 units. So this is where we produce 90,000 units. So we're back to the example from chapter 16. We had a master budget amount of 100,000 units. We created a flexible budget of 80,000 units. Our actual sales were 80,000 units. However, we produced 90,000 units. So that 90,000 units produced affects our manufacturing variances because we allocate overhead based on the units of production and not necessarily on the number of units sold. That goes into cost of goods sold versus cost of goods manufactured. So we're looking at our manufacturing variance. We have our actual quantity produced times our actual price minus our standard price. So we produced 90,000 units. We had a standard price of overhead allocation of $3.80 per unit. However, our actual cost was $4.121 per unit. So we had a total variable manufacturing cost of $28,890, that variance. We also had a fixed manufacturing cost spending variance of $4,500. That was a favorable variance. So we are closing those to cost of goods sold in this journal entry that is below. If we were going to prorate those, in this example, they choose finished goods and cost of goods sold to prorate those amounts to. So they're not going to prorate any to work in process inventory in this example. So they close the majority to cost of goods sold and do 1/9 to finished goods inventory. So this is just an example of prorating a production variance. Companies can choose how they would like to prorate those on their own. So we're going to look at our standard costs. So the standard cost for materials. Again, we're continuing with the information from chapter 16 in chapter 17. So we already had a lot of this information. We have 4 pounds per case at 55 cents per pound. We have 80,000 that we sold in August. And then our actual materials purchased and used were 328,000 pounds. So what happens if we had purchased 350,000 pounds at 60 cents per pound, but 328,000 pounds were used? So we purchased more than we used. So in that case, the price variance is the difference between the actual price and the standard price for the actual number of units purchased. The efficiency variance is the difference between the actual quantity used and the standard quantity. So remember, our actual quantity used was 328,000. Our standard quantity was 320,000. So our efficiency variance stays the same. But our price variance is going to differ because we purchased more than we used. That only affects direct materials because we would carry a direct materials inventory. For labor and overhead, we purchase and use the same quantity, but materials, because we can carry them in inventory, we're going to have a difference in that price variance analysis if we have additional inventory left over. So we do all of the calculations here, where from chapter 16, this is the slide from chapter 16 where we looked at that direct material variance. So now we're looking at it with that materials inventory, where we have purchase versus usage. So our efficiency variance stays the same, but our purchase variance is going to increase because we have those remaining pounds of direct materials in our inventory at that 60 cents per unit cost or per pound cost. So we have journal entry to record the purchase of our materials on top, where we would record the purchase of that 350,000 pounds of material with an actual price of 60 cents per pound against our standard price of 55 cents per pound. And then the second journal entry is to record our amount of materials used. So the 328,000 pounds that we actually used with our efficiency variance account, where we record our efficiency variances for material. Some additional variances that we can look at are what our market share variance and our industry volume variances are. So our industry volume variance is the portion of our sales activity variance due to changes in industry volume. So how did the industry change? Same with our market share. So we would have an idea of what percentage of the market share our product actually has. And so this variance is going to look at the changes in our proportion of sales in the markets in which we operate. So if we said that we had a 15% market share for product A, but our sales were 12% of product A, then we would have a market share variance. So we break out those variances. So we have the 20,000 fewer cases, the difference between our budgeted and our actual sales volume. So our industry volume is 500,000 minus 400,000 times 25%. So 25,000 additional cases. And the market share was 16% minus 25% times 5,000, or 45,000 fewer cases. So why did we sell 20,000 cases fewer than budgeted? So if our estimated sales volume of 100,000 cases was based on an estimate of a total of 400,000 cases being sold in the market, and Peak having 25% of that market, and only 80,000 cases were sold, what happened? So if 500,000 total cases were actually sold in the market in August, Peak should have increased sales by 25,000 cases. That's 25% of the market share. In fact, their market share fell to 16%, which is 80% of those 500,000 cases sold. So that we have a 9% decrease in market share, which resulted in 45,000 fewer cases being sold. So then we would look at our sales activity variance. So our standard or budgeted contribution margin of $5.30 per unit. So our $10 sales price less our $4.70 in variable costs multiplied by 25,000 units increase in peak share of industry sales gives us $132,500 favorable industry volume variance. However, because we lost market share, that gives us the 45,000 units we lost in market share times our standard contribution margin of $5,000 or $5.30, which gives us a $238,500 unfavorable balance. So our total sales activity variance is $106,000 unfavorable.